Hello. Thank you everyone for attending tonight's VRAR Association LA chapter member only meeting. I'm very excited to be up here today. I want to thank Natalie Fernandez and Josephine Muniz for inviting me to speak tonight on behalf of Visionary Tax and on the topic of research and development tax credits for emerging technologies. I think right now it makes most sense to speak about this topic, seeing that we are here in the middle of busy season and currently looking to file tax returns, and there's no better time to look at the research and development tax credit than right now. Like I said, my name is Tyler Kem of Visionary Tax. On tonight's agenda, we're going to be talking about who we are, what a tax credit versus a tax deduction is, a history of the R&D tax credit, what the four-part test is, what activities qualify, what activities don't qualify, what qualified research expenses are, the payroll tax credit for startups, a use case, and then we'll go into any questions here at the end. So first off, who is Visionary Tax? Like I said, my name is Tyler Kem. I'm the CEO and founder of Visionary Tax. We are a boutique research and development tax credit consulting firm that focuses on emerging industries. Visionary Tax works with CPAs, attorneys, accountants, entrepreneurs, and the CEOs and decision makers of small to medium-sized businesses in emerging industries to help maximize federal and state R&D tax credit claims and to minimize year-end federal state payroll tax liabilities. Some of the industries that we are currently working with are businesses in software development, blockchain technology, financial technology, also known as FinTech, virtual and augmented reality, artificial intelligence, engineering, architecture, and manufacturing. Just very high level before we get into what an R&D tax credit is, just want to confirm the differences between what a tax credit and a tax deduction is. So a tax credit is a dollar-for-dollar reduction in year-end income tax liabilities. So a $1,000 R&D tax credit saves you a $1,000 in taxes owed to the IRS or the state, dollar for dollar. Whereas a tax deduction or an expense really just lowers that taxable income. So some of you may have a $1,000 R&D expense on your profit and loss or income statement, and for C corporations that the tax rate is 21%, this $1,000 expense or deduction really saves you $210 in taxes owed, as it does reduce that amount that you would owe during tax time. So the research and development tax credit is a tax credit that's been around since 1981. It was originally enacted under the Economic Recovery Tax Act to help incentivize U.S. businesses to keep these highly technical jobs here in the U.S. Since the tax credit was enacted, it has expired 8 times, extended 15 times, and was made permanent in 2015 under the Protecting Americans from Tax Hike Act. This is important because tax credits and deductions come and go, they change, and now that the federal R&D tax credit is permanent, we as R&D consultants really see it as a staple for startups and qualified small businesses, as well as those businesses that are developing new products, processes, software technology going forward to help reinvest some of that money that's being put into R&D, but also to be used as a tax planning tool that we'll get into here in a bit. Whenever we're looking at if a company qualifies, if a project qualifies, if expenses qualify, we always refer to the 4-part test. So to qualify for the R&D tax credit, the business must meet all 4 parts of the test. So the first part is the permitted purpose. So the intended purpose or the activity must be to create or improve that functionality, performance, reliability, or quality of an existing business component or one in itself. And that can be a product, a process, a software, a technology, a patent, an invention, a formula, what it may be. And the second part is technological in nature. So these activities and processes of experimentation must rely on hard sciences such as computer science, engineering, chemistry, biology, or physics. And the last two go hand in hand: elimination of uncertainty and process of experimentation. So the activities in the project in question must attempt to eliminate that uncertainty related to the design, the method of development, and components capability. Going as far as the process of experimentation would need to include some sort of testing, such as evaluating alternative materials or methods or systematic trial and error. Um, we see this in the software development industry as testing source code, integrating third parties, hardware to software solutions, FinTech platforms, and whatnot. So some of the activities that can qualify here in the software development emerging tech space is software development in itself, so developing source code. Also video game development with animations, as long as it's being funded internally, can qualify. Development of mobile applications. Again, it doesn't have to be new to the industry, just new to the company. So VR and AR applications, development of financial platforms and solutions, also known as FinTech. A lot of these are banking apps, applications to make your everyday lives easier. This can qualify. Patented technology or products, anything that's really patented is creditable. You've already shown that this has not been done before. You pretty much meet all the 4 parts of the test with a patent, as long as you're doing the work associated and you have expenses to tie to that patent. Machine learning algorithms, if you're constantly developing an algorithm that is involved with AI, it's constantly improving that process and that function, and that can be considered qualified. Third-party integrations, any type of back-end development that's happening can qualify. Development of an MVP, as going as far as documenting these results, attending technical meetings, discussing new products, processes, software, technology. This is how we identify how qualified he or she may be, and ultimately how we get to those tax credit numbers. Some activities that would not qualify is research that's done after commercial production. So, bug fixing is a activity that does not qualify, whereas, updating version 1.1 to 1.2 can be activities that are considered qualified. Duplication of an existing business component. So you can't make a product and then the second time take that as being a qualified activity. Just as reverse engineering is not a qualified activity, and market research, also not technical in nature. Foreign research done outside of the U.S. cannot be picked up. So that's part of the incentive to keep these jobs here in the U.S. Research related to social science and arts and humanities is not something that can be picked up. An example here would be you can't pick up a painting or someone that's an artist painting a picture, but if they were to develop a new color, then that's something that could be picked up. Research extended to funded by grant or contract cannot be picked up. You want to make sure that the taxpayer that has the risk and the rights to the technology is being created. So that's something that we look into, whereas work for hire would not be able to be picked up because it's being funded by somebody else. So now when we're looking at, what type of expenses, like how do these tax credits, how are they generated? And so there's really 3 categories of expenses that we look at. The first being wages. So W-2 Box 1 amounts paid to those employees directly performing the research, as well as those directly supervising and supporting the research. Those wages can be picked up towards the credit. The next would be supplies and materials. So those supplies and materials that are consumed or tested during the R&D process. This can include cloud storage costs for research projects. That can be a pretty large expense for a lot of companies, and the allocable portion of cloud storage related to the business component or that new software can be picked up. Lastly, it's contract research. So any amounts paid to outside contractors here in the U.S., a lot of times it's 1099 contractors, to perform the qualified research on behalf of the taxpayer. There are a few logistics that we want to make sure are touched on before we can pick up some of those contractors, but nonetheless, you can pick up 1099 amounts paid here in the US. One of the most important provisions to the PATH Act of 2015 that I really felt was a turning point for the R&D tax credit is the fact that qualified small businesses now have the opportunity to offset payroll tax owed to the IRS on Form 941 on a quarterly basis for the first 5 years that they're receiving gross receipts, as long as they do not go over the $5 million threshold. This is huge for startups. Businesses that had to be in a profitable tax position to use these tax credits was not a large amount of the population. A lot of software development tech companies start investing a lot of money into developing a technology or a software, and because of that you're oftentimes in losses for those first couple years. So why take an R&D tax credit even though you're doing the work if you can't use them? You don't know if tax credit is going to be there in a year or two, as it had to keep being voted on through Congress. And two, you don't even know if the company is going to be around in a few years. You're putting all this money into R&D. Are we going to be able to utilize them? And now that's changed. So qualified small businesses have the choice to either offset income taxes and or against the employer portion of Social Security taxes owed to the IRS. So a qualified small business is any business that has less than $5 million in gross receipts for that eligible credit year, as well as less than 5 years of gross receipts, and has qualified research expenses. So if you can meet these three parts of the test, the federal R&D tax credits that are generated can be used to offset quarterly payroll tax owed to the IRS on Form 941. So this is huge for startups. Again, cash is king for startups, and if there's a way to offset $10, $15, $25,000 in payroll tax with R&D tax credits, I think that's a huge piece for startups that they should be looking into. And so for that reason, I chose to leave the corporate world and get on the ground floor with startups such as yourself and those businesses in the VRAR Association, and really want to help educate not only the entrepreneurs, the business owners, but those CPAs and accountants that are serving the industry that, hey, these are R&D tax credits that can be used from the start as a tax planning tool for any business that's developing a new software technology and in the emerging industry and technology space. I think the question should be asked from the start, hey, can we use these? How can we use this as a tax planning tool? And depending on your entity structure, C corporations, those tax credits are going to be used at the entity level. But for pass-through entities such as S-corps, partnerships, or sole proprietors, these tax credits do flow through to the individual and the shareholders and can be used at the individual 1040 and state levels to offset dollar-for-dollar reductions in what they owe at the end of the year. So again, this can be a tax planning tool depending on entity structure and further utilization. But this next slide is a use case that I hope makes things a little easier. I'm a visual person, so hopefully this helps. The California augmented reality company, founded in 2014, develops an award-winning location-based software and mobile application. With an internal team of 4, the CEO, COO, and 2 software engineers, along with 2 outside contractors, have doubled their gross receipts from $500,000 in 2015 to $2 million in 2017. Here is their research and development tax credit story. The amounts paid to employees and contractors has been consistent year over year. As you can see, the 4 employees' wages totals $425,000, whereas the total paid to contractors is $50,000 each year. After discussing qualifying activities, it was determined that the CEO was 20% qualified, while the COO was 30% qualified, whereas the senior and junior software engineer are 100% qualified. Both the AR developer and iOS Android developer
Although doing 100% type qualifying work, the company can only take 65% of the amounts paid to them each year. As such, $32,500 of the $50,000 paid to both developers can be captured and counted towards the R&D tax credit. As you can see, the total amount paid to the employees and contractors totals $475,000 for each year, whereas the total qualified research expense for each year is $250,000. So let's take a look what the total federal and California state research and development tax credits are. This project involved a 3-year study with a 2-year look back to claim credits for the years 2015 through 2017. The company qualified for federal R&D tax credits of $75,000 and an additional $56,250 in California state R&D tax credits, totaling $131,250 in total R&D tax credits. If a business you know is developing a new software, technology, product, process, invention, or patent, and is paying wages to employees, amounts to contractors, or for supplies for prototypes and testing, it's worth looking into the research and development tax credit to generate R&D tax credits that can reduce or offset year-end federal and state tax liabilities, as well as the possibility of payroll and AMT tax. Feel free to reach out to us at Visionary Tax to help with the estimating, calculating, documenting, and substantiating of your research and development tax credits. Thanks. We hope you guys have a great day. A California.
So I hope that maybe cleared up some of the questions that you all might have about R&D tax credits, how they might be generated, what we look at as far as what expenses can qualify. Of course, there's going to be many, many more questions that you probably have about whether your company qualifies, a company you know qualifies, or if you are a CPA, accountant, attorney that may have additional questions of your own. I definitely advise you to reach out, whether it's at email at tyler@visionarytaxes.com, our work line at 310-430-2422, or any of our social medias. You can most likely find us at Visionary Tax. More than happy to continue educating everyone in the space as well as I can. And, I think it's one of these tax credits that now that it's permanent, a lot more businesses are going to start taking advantage of. A lot more accountants and CPAs and those attorneys are going to start advising on. And so, my vision and hope is that, this is something that catches fire, and it's going to be a great year for R&D tax credits. Please do feel free to reach out if you have any questions. It's been a pleasure. Thank you all.